My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. Other people, my friends, just trying to make a little money. My job is not just to entertain, but to teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, it took some faraway debacle involving a Swiss bank for it to dawn us, just dawn on everybody, that the whole world seems to be having a banking crisis. Banking crisis, very bad for business. That's right. We left here last night feeling good, darn good about the market. Solid bounce in our banks, huge move in tech. At 3:30 a.m. when I get up, I look at always how the markets are doing, and it seemed like we're in for another decent day. Excellent follow-through to a real comeback session. Then, totally out of left field, the Matterhorn of banks, Credit Suisse, lost the support of its biggest backer just when it looked like that it might be turning a corner after months and months in purgatory, with the stock going below $2 in early trading. A particularly brutal come down for a one-story franchise. Yet, we in the U.S. were looking real good until the moment the Saudi National Bank said it would not buy any more shares of Credit Suisse. It already owns 10% of the company. Our market then, out of nowhere, in the dark, that's right, pre-market trading dropped 500 straight Dow points. And that was at 5:30 a.m. By the close, we saw the Dow finish off 281 points. Actually, remember, a rally from 5 a.m. And the NASDAQ inched up 0.05%, but the S&P lost 0.7%. How the heck could the cessation of Saudi investing in one crummy Swiss bank have such an impact here? The answer is twofold. One, it shouldn't. In fact, my squawk on the street compadre, David Faber, has been chronicling the fall of Credit Suisse, the endless missteps for ages. It's almost become a running joke between us. It's a ridiculous sideshow. But two, it seems Wall Street's starting to recognize that instead of a small banking crisis involving three outfits in this country, maybe, and ones, by the way, you probably never heard of until Sunday, we may have an international debacle that's striking a tremendous level of fear all over the place. I'm gauging that fear by what's known as a flight to quality out of anything risky, think stocks, and into safety, think treasuries. Frankly, bonds moved up in value and down in interest rates so fast that you would have thought you were looking at a small-cap tech company that got a takeover bid from Microsoft. Normally, when long-term rates drop, it's great for the economy and even better for the stock market. But you know what? It matters why they're going down. And in this case, rates are going down because there's a widespread fear that there's a global economy slowdown. That's right, that the rapid rate hikes that have been put through by all these central banks are now really starting to hurt business. Right direction, wrong reason. Now, unlike most people, I actually grow more constructive as the market goes lower and interest rates go lower. I saw a lot of stocks get hit today, even though they belong to companies that do just fine in a weak economy. So that's wrong, especially in a deeply oversold market. See, I think that's the opportunity. At the same time, I'm not enthused about any stock in the bank blast zone. Then there's also this third group of stocks I'm working with right now in my mind, the ones that do poorly when the economy falls off the cliff, the steels, the coppers, the Plato industrials. They've come unglued, but the stocks have gone down so fast so far that maybe even they're interesting. Which brings me to the heart of the matter, next week's Fed meeting. Because these cyclical stocks are very much hostage to the Fed, as is, frankly, practically everything else. This is going to be the most momentous Fed meeting in recent memory, because their next move is so significant, and we don't know what it's going to be. As I've been saying for a year and a half, as long as the Fed keeps raising rates, you're going to have a hard time making money in stocks. You always do have a hard time. And that certainly proved to be true last year, and it's happening again this year. But you have to understand, when rates stop rising, it's not look out below, it's look out above. Especially if we hear that the Fed and Treasury and the FDIC are going to guarantee all deposits at all banks around this country, which they must do to preserve the much-beloved community and regional banks. By the way, beloved by both the Democrats and Republicans. Just a week ago, the economy appeared to be running so hot that Jay Powell stunned us with a view that was incredibly hawkish. You know, this 1 week ago, to the point where many investors figured he'd hit us with a 50 basis point rate hike this time because inflation has become so persistent. It just seemed like the rates, they weren't working, these hikes. So maybe the Fed would have to take us up to 6%. I mentioned Jamie Dimon, CEO of JP Morgan, talked about that. I mean, you got to try to cool things down. Maybe it takes 6. Now, exactly 1 week later, after the collapse of Silicon Valley Bank, after the teetering of Credit Suisse. We've gone from thinking that the Fed should raise rates by 0.5% to wondering if it might very soon have to cut rates and stop that thing that's called quantitative tightening, stop selling their bonds, because we're in a real hole. We may have sticky inflation in some related areas involving housing and services, but we also have an economy that appears to hit a retaining wall with credit quality declining quickly and lots of jobs being lost. 1 week. And that's the dilemma that's causing such pressure in the market. To raise or to cut? Or maybe that's not the question. We do 2 programs for members of the CNBC Investing Club. One is at 10:20. That's called the morning meeting. I do these with Jeff Marks. He's my colleague. And the other is called Home Stretch at 2:30 p.m. When we were down big today, I said on the morning meeting that you had to buy the stocks of the drugs, the foods, and senior growth tech, particularly Meta, the cost-cutting champ. Why those? Because they're not experiencing any of the problems that's facing the broader economy. The drug stocks are twice plus. They do well in a slowdown. Many have good dividends that seemed puny when rates were so high last week, but now long rates are moved so low so quickly that the pharma dividends are attractive, maybe even more attractive. Can the market really be that bifurcated? Absolutely. In the vast chaos of the action, I always tell you, and I'm going to spend another whole segment on because it's important when the Dow's down 281, there are always bull markets somewhere. Right now, for example, we have a bull market in semiconductors because there was a huge chip glut. Now it's ending. Buy AMD. We have astonishing breakthroughs in artificial intelligence. Go buy NVIDIA. Next week, Jensen Huang is going to explain to us how much more there is to artificial intelligence than we know. You can buy Microsoft for the same. You know what? You can buy Adobe after that terrific quarter this evening, and you can buy Meta, even though it was up big yesterday and up big again today. It's not done. Billions of dollars in expenses are coming out of that company, but revenue is going to stay the same or even go up. Of course, some areas are just so in the blast zone that I don't want to get behind them. Can't like everything. The bank's too dicey for me. They've come down a lot. But the seizures and the closings last week are really death sentences for these institutions. I don't like stocks that can suffer the death penalty. According to my friend Michael Semblas, he's the chairman of Markets and Investment Strategy for JP Morgan Asset Management, the healthy banks may ultimately have to pay for the funerals of the bad banks. And those funerals can be very expensive. So there go the earnings. Oils, gripped by a deflationary spiral, not so hot. I thought oil would hold 70. I was wrong. They're in free fall. Joy to Powell, not so great for me. And here's the real irony. Why is the Fed still fighting inflation if almost everything has come down in the last 6 days? All the prices are pretty much over. Is the Fed fighting inflation when the most deflationary force there is, a collapse in the banking system, is right in front of us? The answer, anything that can go down this much could conceivably go back that much. That cuts to the Fed saying, wait and see next week. And if we get that, the market could be a coiled spring going higher, not lower. The risk at last is to the upside. Bottom line, these are indeed confusing times. But fortunately, we're close to the point where the Fed may feel the need to take desperate measures that could be fantastic for your stocks, for your portfolio. We just don't know if it'll be enough to outweigh the bad from this snowballing banking crisis. But any more bad news tips this one over the edge to the bulls, not the bears. Let's go to Raphael in Louisiana. Raphael.
Hey, Jim, thanks for taking my call today.
Of course, buddy. What's going on?
I want to get your thoughts on 3M. Today they hit a new 52-week low, and they're still involved with that lawsuit over the faulty earplug. You know, I have them in my portfolio partly because their dividend yield is around 5.8%, which is pretty good. So I want your thoughts on, is it time to buy
I'm
more?
glad you called me on this. Raphael, I'm glad you called me on this. My dad, one of his many jobs was to sell Scotch tape and 3M board games. And I have to tell you, I, too, am very concerned about 3M. The problem with with combat arms is really about tinnitus, which I know very well since I have it. The problem with groundwater, it's almost impossible to get the bad stuff out of groundwater. So I'm very concerned, too. All right, you're right to be worried. These are confusing times, but we're close to the point where the Fed may feel the need to take desperate measures that could be fantastic for your portfolio. We don't know yet, but the risk is to the upside. Mad Money tonight. The banking crisis has the market on edge. I'm actually giving you some specific names to play it. I'll reveal what I've got my eye on. And then, tough day for the averages. T-Mobile managed to end in the green. With news it's acquiring Ryan Reynolds is back Mint Mobile. I'll find out what's next for the company with the CEO and Deadpool himself, Ryan Reynolds. Wow. And a W reported after the bell. So what made this quarter stand out? I'm digging the numbers. The company's top brand, so stay with Kramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.